Are we prepping for a margin meltdown? Is it going to happen?
Well, I think we will get margins coming down, and that's typical as you get economic downturns. Margins are very sensitive to that. And in a sense, really, the surprise of the last quarter was how well both revenues and margins held up. Now, some of that was because actually nominal GDP, which companies are making a claim on, has been quite strong because of higher inflation. But it's also because you had a lot of pent-up demand and savings following the pandemic. And many companies were able to pass on those higher costs. And that's beginning to wane, I think. So certainly, it's not just that earnings are going to be weaker. The market is expecting that, even though consensus numbers have yet to come down. But it's really the forward guidance and the margin that I think is going to be of greatest interest. And that's the area of greatest vulnerability, I think.
Is that priced, do you think, Peter?
It's priced to the extent that, from best we can tell, looking, for example, at how the most economically sensitive companies have been performing relative to those that are quite defensive, for example, a mild recession is being priced on both sides of the Atlantic, a slightly deeper one in Europe. But I don't think the market is really poised for any significant or prolonged recession. Now, to be fair, there are some important supports. Private sector balance sheets are quite strong, banks, households and corporates. And in the case of Europe, at least, there's quite a big fiscal boost that's helping to support growth as well. But I do think earnings numbers will still come down quite a bit. And whether we end up with a recession or not, I think there's a good chance that markets will price that probability as being higher than they have done as yet.
So, Peter, does your base case incorporate a potentially recessionary or slowdown in that we get the margin squeeze now and then we get weaker demand later? Is that your base case?
That's right. Yes, it is. Our base case is based on our economists' central forecast, where they have only a 50-50 probability broadly of recession as they define it. But we are expecting much lower numbers than the consensus.
Right.
As I said, consensus numbers really typically are quite slow to come down at turning points. Markets tend to move a lot quicker. And we should say also that equities tend to start to recover from bear markets 6 to 9 months before earnings begin to improve. So, as you said earlier, they are about anticipating the future. And some of this downturn has been priced, but not enough. And I think, as perhaps you were saying earlier, valuations are not really yet at levels consistent with recessions, particularly in the US. And I think there's probably more valuation compression that can come through.
Peter, can we just deal with the top line and what happens in the middle of the P&L and the sequencing as to how this is going to unfold? At the moment, we're starting to see margin pressure coming through. Costs are rising, be it labour costs, be it sort of input costs more broadly. So that's starting to impact what is happening in the middle. At the top, inflation is supporting a top line, plus, as you say, actually the macroeconomic backdrop with savings relatively strong continues to support the top line. Are we, though, as we go through into the recession, going to see the top line weakening, but the margin squeeze easing? Or does the margin squeeze continue because actually the pressure on the labour market is going to be maintained and actually the supply chain story doesn't ease, and you end up with the worst of both worlds? The top line comes down, but the margins continue to, the input cost story remains relatively high, because that's a 1-2 punch that is going to really have a big impact on the bottom line.
Yes, and that sequencing is not unusual going into downturns. It's really a question of to what extent do you get top line and margin moderating, and which sees the greatest pressure. Now, I would say actually revenue growth, top line, is not likely to be so weak, and that's partly because inflation is higher and nominal GDP is higher. Also, remember, there still is a lot of pent-up demand that we're seeing. The discussion you've just had about airports is a very good example. It's not that there's a lack of demand, it's really an issue of supply. So I think revenue growth can hold it up, but costs are still going to rise.
But if I just to jump in here, the fear for Heathrow, the fear for European airlines is that you have this huge surge this summer, nobody can cope, margins get squeezed, unions get decent pay rises, those are sticky, but come the autumn, actually demand collapses, but the costs are still there. That's the fear. How big a risk is that for equities?
Well, it's a risk from a structural perspective, because I think you have to look at where we've come from. Context matters a lot. If you look at profit margins, they've been rising relentlessly for the last 20 years and reached all-time record highs in the US and close to that in other regions as well. And there's lots of reasons why margins have done well. Uncontained globalization, very plentiful and cheap commodities and labor for a long period of time have contributed to that as well. And as we get more regionalization, less growth in world trade, and as you say, energy and labor is more scarce and more expensive, we would expect margins to begin to come down. Part of that is cyclical. You tend to get margins weakening in an economic slowdown. And part of it is probably structural as well. And that's why we've been arguing that investors should be focused less on revenue growth, which was what they rewarded above all else in the decade after the financial crisis, supported by very, very cheap interest rates, and focus more on the quality of balance sheets and margin sustainability within and across sectors, because I think that will become more valuable as an attribute.
Is there also the possibility here that we get too pessimistic when we look at all the challenges, like you said, and I understand the sequencing into a slowdown, but JP Morgan strategist led by Marko Kalinovic talked about how most investors are already positioning for a recession and sentiment is weak. And if an economic disaster doesn't materialize, risky assets can substantially recover. What would be your take on something like that? And if there is a recovery, where might we see it first?
Yes, well, I would agree that the markets and most investors are increasingly anticipating or positioning for the worst, for a recession. It's not inevitable that we get recessions, or certainly deep and prolonged ones, bearing in mind some of the other supports that I mentioned. You know, labor markets are still very strong, private sector balance sheets are healthy. In the areas that are most at risk, like Europe, you're also getting fiscal support. So if a recession is not as bad as investors eventually end up pricing, there will be a good recovery. And typically, the recovery from a bear market is triggered by a clear peak in inflation and interest rates. So that will be one of the important things to look for. And initially, it would likely be a strongest rebound by the areas that have fallen the most and the areas that are most levered to an economic improvement. I think what happens after that, though, is going to be a different story with slower returns for some time to come.
Peter, final quick question from me. Europe, basically, we're waiting, we're watching, we're trying to understand what A, Russia's going to do, and B, what China's going to do. In the meantime, it looks like a very bleak environment. So the question we've been asking a lot of our guests today, it's our MLive question of the day, is a recession in Europe inevitable? What's your perspective?
Again, I don't think it's inevitable. Where our economists are basically looking at stagnant growth in the second half of the year, with Germany and Italy that are more exposed to Russian gas in particular being in recession. A lot will depend on what happens to gas supplies as we move forward into the latter part of the summer and beyond. And that will determine whether there's a broad recession, and I think how deep. One of the benefits, as I would say, of Europe, though, is that there is a fiscal expansion coming through, and many governments are already intervening to try to reduce the negative shock or moderate it from a real income squeeze to protect consumers to some degree. It won't prevent a recession. It may moderate the extent of it. And do bear in mind, at least, that European markets are much cheaper. They're trading roughly at around 10 to 11 times PE. That's below the long-run average. Maybe not at really stressed valuations, but certainly starting to look quite attractive. And we think the dividends broadly are sustainable over time. So there is some value beginning to come through there.